Index funds are supposed to be the holy grail of investing, right? The safe, boring, guaranteed path to wealth that every financial advisor pushes. Just buy the S&P 500 and forget about it, they say. It's foolproof, they promise. But here's what they won't tell you. Index funds have a dark side that could seriously mess with your financial future. And no, I'm not talking about some conspiracy theory. I'm talking about real problems that affect millions of investors who think they're playing it safe. 67% of investors believe index funds are risk-free. The average investor thinks diversification means they can't lose money. And if you're one of them, you're setting yourself up for a rude awakening. Stick around because what I'm about to share might save your portfolio from some serious pain. And hey, if you're new here, hit that subscribe button and ring the bell. This channel breaks down the investing truths that nobody else wants to talk about. And trust me, you don't want to miss what's coming next. Let's dive in. Dark truth number 1. Index funds create the illusion of diversification when you might actually be dangerously concentrated. When people buy the S&P 500, they think they own 500 different companies. Technically, they do. But here's the kicker. The top 10 companies make up over 30% of the entire index. Apple, Microsoft, Amazon, Google. These giants dominate your diversified portfolio. What does this mean? When big tech has a bad day, your diversified index fund gets crushed. Remember the tech sell-off in 2022? The S&P 500 dropped over 20%, and people who thought they were safely diversified watched their portfolios bleed just like those risky tech investors. It gets worse. Most index funds are market cap weighted, meaning the biggest companies get the biggest slice. So when a stock is flying high and potentially overvalued, the index buys more of it. When it's cheap and potentially undervalued, the index owns less of it. You're literally buying high and selling low on autopilot. Here's the uncomfortable question. Are you actually diversified, or are you just making a concentrated bet on the biggest companies in America while telling yourself you're playing it safe? Dark truth number 2. Index funds are turning you into a passive owner of companies you know nothing about. When you buy an index fund, you're not just buying a basket of stocks. You're becoming a partial owner of hundreds of companies. But here's what's messed up. You probably can't name half the companies you own, let alone tell me what they do. You could be owning companies with terrible management, declining businesses, or practices you completely disagree with. Maybe you're unknowingly invested in tobacco companies, weapons manufacturers, or corporations with environmental records that would make you sick. But hey, it's diversified, right? The really unsettling part, you have zero control. Active fund managers can at least choose to avoid companies they think are garbage. But index fund investors, you're stuck with whatever makes it into the index, no matter how bad it gets. And here's something that'll really bother you. When companies get kicked out of major indexes, guess who's forced to sell at exactly the wrong time? Yep, index funds. They have to sell when everyone else is selling, often at terrible prices. Dark truth number 3. The set it and forget it mentality is creating a generation of financially illiterate investors. Index fund investing has become so popular that people treat it like a savings account that just happens to grow. But markets aren't savings accounts. They're volatile, unpredictable, and they can stay down for years. Here's what happens. Someone starts investing in index funds. Everything goes great for a while, and they think they've got investing figured out. They never learn about valuation, market cycles, or risk management. Then a real bear market hits. Not a little 10% dip, but a proper 50% crash that lasts 2 years. And they panic. These set it and forget it investors suddenly realize they forgot to learn anything about investing. They don't understand why their portfolio is down. They don't know if it'll recover, and they definitely don't know what to do about it. So what do? They sell at the worst possible time, destroying decades of potential gains. The uncomfortable truth is that passive investing requires active learning. You need to understand what you own, why you own it, and how to behave when things get ugly. But index fund marketing has convinced people that ignorance is bliss. Dark truth number 4. Index funds are becoming victims of their own success. This one's going to blow your mind. Index funds now control over 50% of the US stock market. When everyone's buying the same thing, weird stuff starts happening to prices. Think about it. If massive amounts of money flow into index funds every month through 401ks and IRAs, that money has to buy the stocks in the index, regardless of whether those stocks are fairly valued. This creates artificial demand that can push prices way above what companies are actually worth. We're essentially running a massive experiment where half the market is on autopilot. Nobody knows what happens when everyone's following the same playbook. Some economists think this is creating massive bubbles in index-heavy stocks. Others worry about what happens when all this passive money suddenly needs to be sold. Here's the scariest part. If index funds ever fall out of favor and people start pulling their money out, the selling pressure could be absolutely devastating. All those stocks that got artificially inflated by passive buying, they'll get crushed by passive selling. Dark truth number 5. You're paying for free in ways you don't realize. Index funds love to brag about their low fees. Only 0.03% they advertise. Practically free. But free isn't really free in investing. You're paying in other ways. First, there's the spread. Index funds have to buy and sell huge amounts of stocks, and they don't always get the best prices. That cost gets passed on to you through slightly lower returns. You'll never see it on a fee statement, but it's there. Second, there's the tax inefficiency that nobody talks about. When stocks leave an index, the fund has to sell them, potentially creating taxable gains for you. When new stocks join, the fund has to buy them, often at inflated prices because everyone knows the purchase is coming. And here's the big one, opportunity cost. While you're getting market returns, you're also guaranteed to never beat the market. Ever. You're paying for mediocrity with the complete elimination of upside potential. Dark truth number 6. Index funds are creating dangerous market dynamics. When everyone's buying the same stocks through index funds, it creates some seriously weird market behavior. Good companies and bad companies in the same index often move together, even when their individual situations are completely different. This kills price discovery, the market's ability to properly value companies. When buying isn't based on company performance, but on index inclusion, stock prices become detached from business fundamentals. We end up with overvalued junk and undervalued gems trading at similar multiples just because they're in the same index. Flash crashes become more severe because index funds use the same selling algorithms. When the market drops, they all sell at the same time, amplifying the decline. Remember the COVID crash in March 2020? The speed and severity were partly because passive funds were all hitting the sell button simultaneously. Dark truth number 7. You're not as protected from behavioral mistakes as you think. Index fund investors love to say they're immune to emotional investing. I just buy and hold, they claim. But behavioral finance doesn't care about your investment vehicle. Fear and greed affect index fund investors just as much as stock picks. Here's what really happens. When markets crash, index fund investors don't see individual stock prices going down. They see their entire portfolio getting destroyed. That's often more terrifying than watching one stock tank. At least with individual stocks, you can tell yourself the others might be okay. With index funds, everything moves together. The result? Index fund investors are just as likely to panic sell during crashes and FOMO buy during bubbles. They just do it with their entire portfolio at once instead of one stock at a time. And here's the kicker. Because index fund investors often know less about what they own, they're more likely to make emotional decisions based on headlines and market movements, rather than understanding the underlying businesses. Look, I'm not saying index funds are evil. They're a tool, and like any tool, they can be used well or poorly. But the financial industry has sold them as a magic bullet that solves all investing problems. And that's simply not true. The uncomfortable reality is that there's no such thing as set it and forget it investing. Markets are complex dynamic systems that require active attention and understanding, regardless of what you're buying. If you're going to use index funds, at least understand what you're getting into. Know what you own, understand the risks, and have a plan for when things go wrong. Because they will go wrong. It's just a matter of when. Thanks for watching. If this opened your eyes to something you hadn't considered, smash that like button and subscribe for more investing reality checks. And drop a comment below. Are you rethinking your index fund strategy, or do you think I'm completely off base? Until next time, keep learning.